you also need to be looking in growth markets. So tell us a little bit about that. Like, how does that fit into your investment strategy?
Well, I think uh, as far as growth markets go, it's sort of standard portfolio theory, no matter what you're investing in, combination of stocks, bonds, real estate, etc.
Welcome to the Stephen Lee Thomas Show, where we provide expert advice for real estate entrepreneurs. And I'm your host, Stephen Lee Thomas. And it wasn't that long ago that I was navigating the challenges of real estate investing, learning from my mistakes, and building the business I have today. I created the show to give you simple, actionable, step-by-step strategies to help you do the same. Each week, we bring you in-depth discussions with industry leaders and professionals who share their knowledge and practical tips. So sit back, take notes, and let's dive into today's episode. Hi, welcome back to the Stephen Lee Thomas Show. I'm your host, Stephen Lee Thomas. Today, my guest is Michael Voulgarakis. I believe I've got that right. He's going to correct me if I've got it wrong. Michael's got 18 years of experience in the commercial real estate space. He has done extensive underwriting, capital raising, asset management. He's done 26 deals, 18 of which have gone full cycle, over $300 million of managed assets. A powerhouse. Super excited to have him today. Michael, thank you so much for joining me. How are you?
I'm doing great, Stephen. I appreciate you having me.
Absolutely. Where are you calling in from today?
I live in Richmond, Virginia.
In Richmond, Virginia. Now, I was going over your bio and we were just chatting before this. Your investments are not actually where you live in Richmond, Virginia. Maybe not all of them, anyways. And so they're actually over in the Washington area. So I'm going to start there because I love this idea about being an investor, but not having to live where you invest. So paint the picture, like back us up a little bit in time. How did that happen? How are you like 2,500 miles away, maybe further from where you're actually doing your investments?
Well, my partner and I started investing in the Seattle area of Washington State about 10 years ago. And we were in New York City at the time. And we saw just an incredible opportunity in that market. And we did have a connection. We knew some people who actually lived in the market and that could oversee renovation work for
Hmm.
properties that we were buying. So that's one of the reasons why we decided to move forward. We had some trusted partners that would be on the ground with the assets.
Nice. Well, that's great. So, I live in California, but I don't invest here. Everything I do is in Texas or further east than that. So I get it. I'm able to have some partners that live in the area. They can be boots on the ground, and then I can be here. I can do a whole lot of things arm length. So I'm glad that that's working out for you. Um, Going back even a little bit further, how did you get into like apartment investing? How did your life lead you to that path?
Well, it goes all the way back to when I was a kid. My father was a home builder, so I worked on construction sites for newly built homes or for renovations. Worked with a lot of tradesmen, became very familiar with building systems. And after I graduated from college, I had a corporate job, but I had this itch to invest, and I started buying condominiums in the town I was living in and
Okay.
renovating them and flipping them. Some I held for longer term, and then I realized, I was making more money flipping condos than I was at my regular job, and I just loved what I was doing. That I decided to go back to graduate school for commercial real estate finance. So I got a master's degree at New York University, took a job in commercial real estate finance in New York City,
Okay.
and from there worked various underwriting, appraisal, and asset management jobs. So while in the depths of the Great Recession, I should say, when lending just started to come back in 2011,
Uh-huh.
I had a great job that was underwriting bridge debt for distressed assets around the country, primarily multifamily. So I had a front row seat to how sponsors were buying these assets, renovating them, re-tenanting them, and turning around and making an awful lot of money. And my partner and I met at that job, and we wanted to start investing on our own, and the rest is history.
Okay, we're gonna hang out in the recession space for a little bit. And the reason why I want to do that is because for me, I really want to get your insights on this. I have studied a lot in the last few years, like the history, trying to look back at 2007, 8, 9, 10, 11, and understanding what was happening there in the market. Um, I believe there's a lot of similarities. It's not the exact same story, but I think there's a lot we can learn. In 2021, 2022 commercial real estate was hot. It was overvalued, and everybody was buying stuff up with bridge debt. What I've seen in the markets I invest in is a lot of the values have come down 25, maybe even 40%. So we've all got these battle scars. We're just like, this sucks. So you've been in it much longer than I have, and you had that front row seat. Here's what was really interesting, what you just said right now is you said you got to watch a lot of people buy distressed properties using bridge debt. So those of us that just bought stuff over the last, couple of years, well, a few years, a little bit farther back, we use bridge debt and we're like, oh, bridge debt sucks. I want your perspective on it because a lot of it's like, I don't want to touch bridge debt. I just want something stable and long term. But maybe there's something that we aren't seeing. Michael, like, what are your thoughts? Like, what's your strategy right now when it comes to acquiring properties? Are you bridge debt friendly or you aren't? Like, what's your game plan?
Well, I think it's a great question. And I have a two-part answer. One, I'm not afraid of bridge debt. And it really has to do with what basis you're buying a property at. If you're buying it at X dollars per door, and that is a discount to where values were in 23, 22, 21,
Hmm.
and you're recognizing that, okay, this is the return metrics are really fantastic at whatever that lower basis is. And if then it makes sense to use bridge debt, right? Because bridge debt is where lenders will give you proceeds based on forward-looking valuations,
Hmm.
right?
Hmm.
So you can project that the more meat on the bone, as we like to say, there is, that makes more sense to use bridge debt. So similar to construction financing,
Right,
right?
right.
If there's a lot of upside and your basis is really great, so your downside is mitigated to a degree, then it makes sense to use that short-term floating rate debt at that point.
Okay.
The second part of that is I think investors in general always need to be asking themselves at any time they're looking at a new deal, what part of the real estate cycle is this particular market or submarket in right now?
Hmm.
Because
Hmm.
if you're at what's called the peak where there's oversupply, and layer onto that what the Fed has done over the past few years, which is raise interest rates really high. That's a signal that you are at the end of a market cycle. So putting bridge debt on something at that point in time is far riskier than putting bridge debt on an asset that is at the beginning of a new cycle with asset values and a basis per unit that is much lower than they were just a few years prior.
Okay. So I'm gonna speaking of market cycles, because I have gone and I have looked at debt cycles over time, probably the last, I don't know, 60, 70 years to try to understand that better. as well as market cycle from a commercial real estate perspective, looking at it from a cap rate, as well as property values. Um, and here's one thing I've learned. My crystal ball is very cloudy. It's extremely cloudy. I wish it was crystal clear, but it's not. Um, so in terms of market cycle, where do you think we're at in this cycle from a property valuation standpoint? If you're enjoying the podcast and want to fast track your way to becoming a full time real estate entrepreneur, then join the Multifamily Mastery Hub on School. You'll get access to our educational course library, live trainings, live interviews, and a community dedicated to helping you succeed. Visit school.com/multifamily mastery hub. That's SKOOL.com/multifamily mastery hub and fast track your way to becoming a full-time real estate entrepreneur today.
Well, I'll answer that by talking about the market overall, meaning the
Okay,
countrywide, and then I can speak
perfect.
about Seattle specifically,
Okay,
because I know that market. But I can't talk about any other markets because I'm just not playing there.
fair,
Um,
fair.
so overall in the U.S., I think we are at the bottom of the last market cycle at this point, or reaching it. The shakeout, the full shakeout rather, of values has, I don't think we're done with that yet. I think there's more pain to be felt in the market, and that's simply a function of the fact that lenders have not taken the keys back on enough properties at this point. But what we
Mm-hmm.
know is that special servicing has an increased amount of delinquent properties, in their portfolios. They just haven't come back out onto the market yet, right? They're working terms out with borrowers, but that pain is not showing up in the market yet. So until that happens, you're not at the bottom.
Okay.
Um, as far as Seattle goes, I think we are right about at the bottom of the market. Seattle has one of the lowest delinquency rates for commercial mortgages in the country.
Okay.
So we're seeing values that have dropped based on the interest rates being higher and thus cap rates going a bit higher as well.
Mm-hmm.
But the underlying economic fundamentals are so strong and there's so little distress in the market that that's why I think we're getting close to that bottom, much closer than I think in the rest of the country at this point.
Got it. Got it. Yeah, I agree with you there. As a property owner, as a multifamily property owner, um, one of my properties is bridge debt, and we are navigating that issue. I mean that's to put it lightly. We're navigating that as we speak. How long can we be in the position we're in, which is like holding on by fingernails, until we can get to the other end of the cycle? And we've all been expecting to be, come back up a lot sooner, but it hasn't. And I do agree with you. I think there's still a fair amount of inventory out there of distressed properties that the banks have not taken the keys back, as you've said. I do think there's a fair amount of inventory out there. So I don't know that we've hit rock bottom. I think there's still a little bit more to go. Maybe not. I mean, there's the crystal ball's cloudy, but yes, I agree with your overall sentiments there. Now, for you in a market like Seattle, um, so when I think of Seattle, I think of compressed cap rates. There might be an opportunity now, and you've been in the space for a while. There might be an opportunity now more so than there has been in the past with valuations coming down and the economics, like you stated, in the market, being very favorable. Is that part of your strategy?
Yes, we're actively looking at deals at this point. We're seeing some more attractive deals than we had over the past few years, for sure. To what degree, I can't say just yet. We're working through all the deals that have come out over the past month and a half or so. But one metric that I can point out is we are seeing a lot more deals on the market than we had in the past 2 years. It's typical in mid-January in any market across the country for a lot of deals to start coming out, right? You
Hmm.
come back from the holidays, the brokers get their marketing teams together, and the offering memorandums go out, give or take the second week of January. So there's been an incredible amount of properties that have come on the market, but we are working through those right now to see, where pricing is. Preliminarily, we're seeing some properties that have what I would consider realistic seller expectations.
Uh-huh.
There's others that are I think still hanging on to 2023 type 2022 valuations.
Uh-huh.
So it's really kind of an across the board type of feel right now in the market.
Gotcha. Yeah, there's some. So in Texas, I'm looking primarily in the Texas, Dallas, Fort Worth area, and what you just said, identical. They're starting to get some more deals come out. Some are very like realistic, and some are. Well, I was just looking at one yesterday, and it was like, there's no way. Like that's just way overpriced. It's just it. Unfortunately, it is, and but you're starting to see a little bit more realistic pricing out there based on our underwriting structure, anyways. Um, okay, last question on this topic. When you're underwriting your deals, are you and I'm just hanging out in this bridge debt area? Are you looking primarily at agency debt, bridge debt, or both? Whatever would make the deal make sense, and it's really property specific.
It depends on whether it's a value add deal or a core deal. For
Okay,
us, value add, we're typically going to have to use bridge financing because a lender, an agency lender, any perm lender is not going to give us enough proceeds to make it worth our while to do a medium to heavy value add renovation.
gotcha. Okay,
Um, but for a core deal that may be stabilized or near stabilization, we would certainly look to um, a perm lender for that. We have some good relationships with some local lenders in that market, which are very competitive. But we always also look at the agency financing as well for those types of properties.
gotcha. Gotcha. Okay, great. All right. So moving on in your bio and your marketing material, you have this comment about investing in blue cities. And I got to be honest, I don't know what you mean by blue cities. I think I know what you mean, but so tell me about this. Why do you think investing in blue cities is still a big opportunity? Like what does that mean and where's the opportunity there?
Well, it's simply a reference to politics,
Okay.
whether a city is right leaning or left leaning, and I've heard after talking to so many uh, people across the country that there's a lot of people out there that say, I want nothing to do with investing in what they consider a blue city, right? They put Seattle in that category along with
Uh-huh.
California cities or, a Minnesota, for example, Oregon. Um, However, I would urge people not to make a blanket judgment about a whole city or a whole state. I think what that does is they lose out on niche opportunities in those areas because for sure there's a lot of real estate in all those blue cities and blue states. So someone is making money off that real estate through whatever strategies. And I know a whole number of sponsors that operate on the West Coast in blue states, blue cities that have a niche, and they're making very good money in those niches. So before your listeners say, "I want nothing to do with that city," they should instead open up their ears and be open to hearing what that particular sponsor strategy is, because I think they can learn an awful lot. And also, if there's less people flowing to those areas, you may have less competition
Mm-hmm.
in those
Mm-hmm.
areas. And, Sam Zell was a huge advocate, the famous real estate investor, one of the most famous of all time. And he said, I would prefer to go to areas where there is less competition, number one. That was one of his first criteria. So, um, and again, it really depends on the strategy that a sponsor would have. Ours happens to work out very well for us, buying value add infill properties, which are very close to the major employers in the Seattle market, and renting to very high household income tenants.
Gotcha. I agree with that, and it's something a paradigm shift I went through recently, to be honest. And I've been investing in apartments for the last 7 years, a little over 7 years. So I live in California, but I was always told like poo poo on California, don't invest there. Um, but I started looking around in my own backyard, and for example, in California, you mentioned, niches. So the area I live in, it's actually the fifth largest city in California. And you wouldn't think that because you have an area like San Francisco or LA. Well, San Francisco's got a whole bunch of little cities next to it. And LA, the same thing, and it's very impacted. But where I live, it's the one of the fastest growing areas in California. People are leaving those other areas and coming here. And so you've got that. There is not a lot of competition. There just isn't. And as I started digging into it, there's this, rent control in California. Well, actually, I can increase my rent year over year by almost 8%. As I start uncovering it, I'm like, 8% year over year. Like, who does that? Like, nobody does that. So when I start pulling back the covers, I'm like, I think there's a huge opportunity I've just been missing out on because I was so blinded by what everybody else was saying. So I appreciate that perspective. And nobody told me that. I had to just kind of like, maybe I should look around here and see what's going on. I asked a few questions. And it was like, wow, like there's a good opportunity here. So I think that's really good. And I think also to your point, understanding your sponsor, where they're at, have they done their due diligence on the market itself is probably also really important for that. So debunking the myth of blue cities, I love it. I love it because I think it's a whole lot of opportunities that we're all missing out on. Everybody goes to like one city and there's too much competition and you're just missing out. You just can't get into it. So along that, we got blue cities, and then you also need to be looking in growth markets. So tell us a little bit about that. Like, how does that fit into your investment strategy?
Well, I think uh, as far as growth markets go, it's sort of standard portfolio theory, no matter what you're investing in, combination of stocks, bonds, real estate, etc. That if you're of a certain age, on the younger side of your life cycle, that you should have a certain percentage of growth investments in your portfolio, right? You
Hmm.
have the time to see those investments bear fruit, right? As you get older, you typically you sort of downshift on your growth investments and start moving into sort of safer investments that don't yield as much, but offer a lot more downside protection, right? You're more interested in principal preservation at that point. So whatever time frame an investor might be in, if they're very, very young, right out of college, they have some money to invest, or through their 40s, um, that having exposure to a real estate growth market, and Seattle is one of those markets, makes sense. What you're backed by is this incredible talent magnet that is Seattle. And it attracts some of the most educated people in the world. And in fact, it's the most highly educated of the largest 50 cities in the United States. I think something like 64, 65% of people in the city have at least a bachelor's degree. And where do those people work? Well, they work in what I like to call the industries of the future. They work at Amazon, Microsoft, Adobe,
Hmm.
all the other big tech names that you know about, along with Boeing and SpaceX, as well as Blue Origin. And there's an awful lot of biotech and medical, brain trusts that are in that market as well. So you have, what does that correspond to? You have highly educated, those jobs of the future. That corresponds to highly paid employees, highly compensated employees. So we like to rent to those folks because of the top line stability in our revenue. Our revenue is incredibly stable in that market because we're renting to people that, on average, make close to $100,000 a year.
Gotcha. That makes a lot of sense. I like that perspective there. And the whole time you're talking about Seattle and being a hub for smart people, um, there's also this big wave of AI, and I kept going on in my head. Do you think that, how do you think AI will impact the growth or what's going on in that market? We'll just leave it there. And so here's something else. I want to say I heard that Microsoft is looking to recommission because they're out of Seattle, right? Microsoft.
They're out of Bellevue, which is just across a body of water to the east of Seattle.
Okay. So I heard that they were trying to recommission some nuclear power plants to um, power AI. And I think there's gonna be some crazy thing happens with AI, but is that on your radar at all? Are you guys thinking about the growth and impact that might be happening with all the jobs and things that are created specifically in that region?
Well, we are. We're certainly aware that so many of the job openings for Amazon, Microsoft are AI related. Right?
Okay.
There's a lot of job growth there, uh, and one of the things that we do like about Seattle is that, or Washington State in general, it's the state that has the uh, highest amount of hydroelectric power in the country. So I think something like 60 odd percent of the electricity is
Wow.
hydropowered. So, you have a sustainable resource there. But as far as, bringing nuclear power plants online, I also heard the same thing. Just goes to show you how, power intensive,
Yeah.
the AI processes are. And I think that's going to be, it's going to carry across throughout the country. Whether it's Amazon's facilities in Arlington, Virginia, right, just outside DC, or if it's going to be a data center that they have, elsewhere around the country. I mean, power is going to be certainly an issue.
Yeah, I think I'm sort of wrapping my brain around the whole thing that's accelerating so quickly, and what's going to happen with where those hubs are, because I imagine there'll probably be hubs. My crystal ball is very cloudy, but there'll be these hubs, and I think that knowing that the for you guys, the Seattle area is a tech hub. You got Silicon Valley, but the reality of is California gets a lot of their electricity from out of the state, so we're gonna have to get it from someplace. They're probably not gonna like go build anything crazy there to generate more power, but so I think you're in a unique spot there. I think there will be just naturally, even organically, there'll be growth just to support what's going on there. I think you guys are in a good spot there. Shifting over a little bit, thinking about going all the way back to 2007, 2008, and then when you were getting into the recession there, and then we've been going through choppy waters over the last few years. Multifamily investing, recession resistant or not? Like why should people invest in it or not? Like how, will it help them not? Like what are your thoughts on how recession resistant is this multifamily housing?
I think that a lot of people make a blanket statement similar to the, don't invest in a blue state or a blue city. And I think that's, it can be dangerous for people to say, oh, multifamily housing is recession resistant. I'm not saying it's not true,
Mm-hmm.
but what it depends on is the jobs that are backing the people that are renting your units, right? Where do those people work? How much do they get paid? And are those industries that they work in ones that will be around through the whole period or the time frame through your whole period that you own the building? You know, if you own a property, buy a property in a secondary or a tertiary city that has only one or two employers, so it's not terribly, you know, economically diverse,
Mm-hmm.
and that employer downsizes, shuts down, or anything bad happens to them because, you know, they are getting overtaken by, you know, whether it's AI or offshoring, then you're in a very bad position at that point, and it's not recession resistant. So what I would urge people to do is dig into what the local economy is powered by. What are those jobs, and what do those jobs pay, and where is your tenant base working? And you have to make a judgment call from there regarding whether or not you think those employers are going to be around and whether wages are going to grow over your whole period. I think that's a very important thing to factor in.
I appreciate that perspective, and it really ties in, I think, to your comments earlier about growth markets. When you have a market that's big enough, there's not, like you said, a one or two large industries there that are employing everyone. Then you've got some diversity within in the market. 'Cause I've seen before where you've got a things are going good and maybe there's a military base, and then if they close the military base down, you're done. Like there's like what do people go do? So that definitely can be an impact there. So I appreciate that perspective because it is not bulletproof. Like you said, there's you gotta uh, consider the other factors that go into that. So, Michael, I've really enjoyed having you on the show today. I could go on and on and on, but we're at the end of our time. You've been doing this for quite a while. If you could go back to when you started your journey, what advice would you give yourself?
Well, if I were to go back, I would say that I probably would have gone straight to uh, the investing side first, meaning, you know, I took a job as an underwriter on the debt side, which was fantastic, but I probably would have pursued an opportunity working for a principal or a sponsor, a firm that is out buying buildings or constructing uh, properties, and gone from there. So my route was a little bit circuitous, if you will, and I think I could have gotten to where I am now a bit faster.
Gotcha. And for people who are just starting their journey, maybe they've got some experience in single family, maybe they're, exploring wholesaling or flipping. You had mentioned earlier in the show that you had been doing duplexes at work. You've leveled up from there. What advice would you give yourself? Would you start that same path or would you try to get into the larger multifamily faster?
This is a great question. I've had a lot of thoughts about this. My partner and I have discussed this at length, and I think ours, you know, our journey, starting with smaller properties with just our own money and growing from there, is the longer path. It's a bit harder of the path, but what I think that has provided us, and this is feedback from existing and potential investors that we've talked to, is that they appreciate the sort of proof that we've provided, right? We're not jumping into a 100-unit building right away. You know, we've been through you know, over 40 transactions, right? Where so many purchases and so many sales that we've really refined all the numbers when we're underwriting a deal. And without that experience going through all those transactions, our experience would not be nearly as rich. And I think at the end of the day, that shows up. It shows to investors, I should say, and it really shines through, and they appreciate that.
That's awesome. I'm sure they really truly do appreciate that, especially navigating the last few years. It probably hasn't been nearly as rough for you as it has been for others because of that experience that you bring to the table. So, Michael, anybody who's listening and wants to get a hold of you, what's the best way for them to do that?
The best way is to visit our website. The company name is Southgate Ventures, and the website is sreventures.com. Again, SRE Ventures, VENTURES.com.
Great. Michael, thank you so much. I appreciate you. For those of you listening, I appreciate you listening to the call. I'm your host, Stephen Lee Thomas, and I'll see you in the next show. Thanks for tuning in to the Stephen Lee Thomas Show today. And if you found value in today's episode, then I have a favor to ask you. Please share it with friends, family, and anyone who might benefit from the insights we shared today. Also, don't forget to subscribe and leave a review if you enjoyed the show. And if you aren't already part of our school community, then head on over to school.com/multifamily mastery hub and join today. And again, thanks for tuning in, and I look forward to connecting with you in our school community.